So imagine you walk into a bank this week.
Okay, just a normal errand, right?
Right, just a normal Tuesday. You want to buy your first home, you sit down, you hand over your financial documents, and the lender looks at your, modest salary.
Yeah.
And then they just mathematically multiply it by 7 and hand you the cash to buy a house.
Which is, I mean, that is just terrifying.
It's completely wild. I mean, back in 2008, handing out these highly leveraged mortgages basically caused a catastrophic global financial meltdown.
Oh, absolutely. It broke the system.
Right. But today, I mean, as we sit here today on August 3rd, 2026, it has literally become the standard mechanism for buying a starter home in the United Kingdom.
It completely defies all traditional risk modeling. I mean, we are really watching a global economy that is splitting into two parallel, totally contradictory realities right now.
Yeah, the contrast is what's so jarring.
Exactly. On one side, you've got these working class consumers who are taking on these dangerous levels of debt or, even turning to petty theft just to afford a tank of gas.
Right, just basic survival.
But then on the other side, artificial intelligence and tech sectors are generating so much immense frictionless capital that software engineers are literally exploiting these complex philanthropic tax loopholes.
Just to manage the overflow of wealth.
Right. Just to manage their untaxed wealth because they have so much of it.
So untangling those two very different realities is basically our mission for this analysis. We're going to explore these bizarre money mechanisms, extreme consumer behaviors, and frankly, the massive government interventions rippling through your daily life right now.
It's touching everything.
It really is. We're looking at everything from normal commuters who are abandoning normal sedans for, like, $15,000 glorified golf cart.
Which is a huge trend right now.
Massive trend. All the way up to these giant joint currency interventions by the world's largest central banks. But, I mean, to understand why normal financial gravity seems to have totally inverted, you really have to trace the pain to the very top of the physical supply chain.
Yeah, and the distress signals are flashing the loudest right now in the industrial data.
Okay, lay it out for us.
So the July ISM Manufacturing Index, which, tracks the health of the physical goods sector, it presents this really fascinating contradiction right now.
How so?
Well, the headline number just came in at 55.6.
Okay, and just for context, a 55.6 reading sounds pretty positive on paper, right? Because technically anything above a 50 on that ISM index means the manufacturing sector is actively expanding.
Expanding in volume, yes, absolutely. But they are completely choking on costs.
Oh, okay. The catch.
Yeah, it's a big catch. When you peel back that headline figure, the prices index is sitting at an agonizing 71.1.
Oh, wow. That's high.
It's incredibly high. I mean, we are looking at 22 consecutive months of aggressive compounding price hikes for raw materials.
22 months. That's almost 2 years of just relentless inflation on the manufacturing side.
Exactly. And executives are genuinely panicked. I mean, there was one executive in the primary metal sector who explicitly noted that the current pricing volatility and the lead time extensions are actually worse right now than the peak pandemic era.
Wait, really? Stating that supply chains are functioning worse right now than when the entire globe was basically under lockdown is a staggering reality check.
It sounds like an exaggeration, but the math backs it up. It's harder to navigate now.
Well, to figure out why moving metal and plastic is so insanely difficult this summer, you really have to look at the physical map. The mechanism driving all this industrial friction leads straight to the Middle East.
Yeah, specifically the ongoing war with Iran.
Right. And that conflict has essentially severed the central artery for global energy.
It really has. I mean, before this war escalated, roughly 20% of the world's total oil supply flowed straight through the Strait of Hormuz.
Which is a massive bottleneck even in peacetime.
Exactly. And now we have this recent tracking data from Kepler, they're a major commodity analytics firm, showing that traffic through that vital strait has completely collapsed.
How much of a collapse are we talking about?
We've gone from over 100 of these massive tanker ships passing through there every single day down to just 8.
Just 8 ships a day.
Yeah.
I want to put the physical reality of that Kepler data into perspective for you.
Yeah.
Because it's hard to visualize.
Yeah, give us the analogy.
So imagine a massive multi-lane interstate highway, right? And it carries literally everything you buy. Suddenly, it gets completely barricaded.
Total closure.
Total closure. So all those massive 18-wheelers are abruptly forced to exit onto this dangerous, completely unpaved back road.
And in the maritime world, that unpaved back road is the Red Sea.
Exactly, which is actively under fire by Houthi fighters right now. So taking that detour requires vastly more time, it burns an incredible amount of extra fuel, and it triggers these astronomical insurance premiums.
Yep, the insurers are definitely getting their cut.
Right. And ultimately, when you, the consumer, buy a pair of shoes or a new refrigerator, you are paying the toll for that massive oceanic detour,
And the immediate financial casualty of that detour is the global diesel market.
which impacts everything.
Everything. Because when you combine the Middle East conflict with the damaged Russian refining capacity, the world is suddenly short roughly 8% of its normal global diesel demand.
And diesel is basically the absolute workhorse of the physical economy.
Exactly. Every freight train, every cargo ship, every delivery truck, they all rely on it. I mean, look at California. They operate the busiest container ship port complex in the United States.
Oh, yeah, LA and Long Beach.
Right. And diesel prices out there have spiked to a punishing $6.92 a gallon.
Wow, $6.92.
Yeah. And that sits in stark contrast to the U.S. average, which is hovering around $5.36 right now.
Okay, so the ripple effect of California's fuel premium is what makes this so painful for the broader economy.
Because it doesn't stay in California.
Exactly, because nearly a third of all U.S. shipping imports touch down at those West Coast ports.
Yeah.
So before a consumer product even reaches a warehouse in, Ohio or Texas or Florida, it's being hauled by a truck that's burning fuel priced at a nearly $7 a gallon premium.
And the company isn't going to just eat that cost.
No, the consumer ends up eating that margin. And ground freight is really only half the story here.
Right, the airlines.
Yes, the airlines are passing on billions in unexpected jet fuel costs as well. If you look at federal transportation data, U.S. airfares in the second quarter were up 26.5% compared to last year.
26% in 1 year. That's just brutal. But, companies will always exhaust their own profit margins before passing costs to the consumer. The problem is, a 22-month run of inflation just obliterates that buffer.
There's no margin left to absorb it.
None. When a basic input like maritime insurance or jet fuel stays elevated for this long, businesses are mathematically forced to hike the final retail price.
And the cumulative pressure on the median household budget becomes severe, which is really what forces the market and the consumer to invent entirely new, sometimes desperate financial behaviors just to survive.
Because if normal people literally cannot afford a basic plane ticket or $7 a gallon gas, something fundamentally breaks in their daily routine.
Right. You can't just stop going to your job.
Exactly. You have to get to work, so people resort to extreme survival tactics. I mean, look at the reality playing out at gas stations across the United Kingdom right now.
The theft numbers are insane.
They are. In the 5 months since the Iran war started, drivers have stolen an average of roughly £200,000, which is about $268,000 worth of fuel every single day.
Every single day. That is just wild.
It's a 24% jump in the actual volume of stolen fuel. And that fundamentally alters the business model of running a gas station.
I would imagine.
Yeah, the desperation has reached a point where traditional deterrents like standard CCTV cameras are completely ineffective.
People just don't care if they're on camera anymore.
No, they don't. So station owners are now being forced to install advanced facial recognition technology right at the pumps.
Wow. Facial recognition just to buy gas.
Yep. Because when the basic cost of commuting to work becomes prohibitive, a significant segment of the population just decides the financial risk of theft is lower than the financial ruin of losing their job.
And that level of financial desperation at the pump is bleeding directly into the housing market, too. It's completely rewriting the rules of how people buy property over there.
The UK housing market is in a really strange place right now.
It really is. I mean, the average house price in the UK has hit nearly £300,000, so almost $400,000.
Which is completely decoupled from wages.
Completely outstripped any meaningful wage growth. And consequently, regulators and lenders have just quietly dismantled the lending safeguards that were put in place to protect the economy after the 2008 crash.
Yeah, the regulatory consensus for the last, 15 years was that a stable mortgage should be capped at around 3.5 times a buyer's annual income.
Right, that was the golden rule. The mathematical barrier designed to prevent systemic cascading defaults.
But as of this week, we're seeing niche lenders and building societies aggressively offering first-time buyers mortgages that are 6 or even 7 times their annual salary.
See, that allowing someone to borrow 7 times what they make in a year is terrifying to me.
It's a massive risk.
It's so risky. Giving a struggling buyer a heavily leveraged loan does not magically make a $400,000 house affordable. It just gives them more rope to hang themselves with.
That's a very grim way to put it, but it's mathematically accurate.
Well, I mean, if the macroeconomy turns, or if one earner in a household takes a pay cut, there is zero margin for error there. We're risking a slow-motion replay of the 2008 subprime crisis purely to maintain the illusion that the middle class can still buy property.
Well, policymakers and lenders would argue they're completely trapped by the math.
How so?
They cannot build physical homes fast enough due to all that industrial supply chain friction we just discussed.
Mhm.
And they can't magically lower the cost of the asset.
So they just stretch the debt.
Right. The argument from the building societies is that these specific 7X products require, like, pristine credit scores and long-term interest rate locks, making them safer than those adjustable rate mortgages we saw in 2008.
Sure, on paper.
Yeah, but they mathematically have to stretch the debt limit, or else the entire starter home market freezes completely.
I mean, I get the lender's logic, but human circumstances just do not care about pristine credit requirements.
Oh, absolutely not. Real life happens.
Right. Illness, job loss, or a sudden $5,000 emergency repair on your house, those things don't respect the terms of long-term rate lock.
No, they don't.
And when traditional physical assets like a single-family home or even just a standard four-door sedan become mathematically impossible for the middle class to acquire safely, the market is forced to invent these completely bizarre, smaller workarounds.
Which brings us to what's happening on the roads right now.
Yes, Americans are fundamentally changing what it means to drive a car.
The data points to this massive structural shift toward micromobility.
Because normal cars are just too expensive.
Exactly. The average cost of a traditional new car is hovering around $50,000 right now.
Which requires a huge monthly payment, plus that expensive insurance we talked about.
So to bypass that entirely, consumers are rapidly adopting what are called electric low-speed vehicles, or LSVs.
Which are essentially glorified street-legal golf carts, right?
Pretty much. I mean, they're equipped with basic safety features like seatbelts and turn signals, but yeah, they're tiny.
And we're seeing automotive startups like Chip Motors alongside these massive legacy giants like Stellantis, who's currently rolling out the Fiat Topolino. They're selling these tiny cars for roughly $15,000.
Which is a fraction of a normal car.
A huge fraction. The appeal is entirely based on stripping away all the friction of modern driving.
Yeah.
I mean, they cap out at 25 miles per hour.
So you're not taking these on the highway?
No, definitely not.
Yeah.
But they don't require any expensive proprietary charging infrastructure because you can literally just plug them into a standard wall outlet in your garage.
Which is incredibly convenient.
Very. And President Trump is actively pushing to ease federal regulations to get even more of these microcars onto American roads.
And the economic trajectory for this specific workaround is staggering.
What are the projections looking like?
Well, analysts at McKinsey estimate this global micromobility market could hit $340 billion by 2030.
$340 billion. That is not a niche market anymore.
No, it's a perfectly rational market response to an affordability crisis. Think about it.
Right.
If a household cannot mathematically afford that high-priced California diesel, or the rising maritime freight costs that are embedded in auto parts, or the principal on a standard $50,000 vehicle,
then a $15,000 LSV becomes a really logical second vehicle for running local errands.
Exactly. It's just adaptation.
And by the way, if you love tracking this kind of market weirdness or untangling these consumer trends, you can find more of our financial candy analysis, plus brain candy and classic audiobooks over at clarineratio.com.
It's all about how people adapt, right?
Exactly. Now, while consumers are finding these little micro workarounds in their driveways, governments are attempting to fix their own massive macroeconomic imbalances using sheer financial brute force.
The currency markets have been wild this week.
Yeah. We just witnessed a very rare, massive joint intervention by the United States and Japan to artificially prop up the Japanese yen.
Because the Japanese currency fell to a 40-year low.
Which is a disaster for them.
Oh, it creates severe import inflation for a country that has to buy basically all its energy and raw materials from abroad.
Right. So to halt that slide, Tokyo stepped into the open market and purchased roughly $59 billion worth of yen.
$59 billion.
And simultaneously, the U.S. Treasury stepped in and bought an estimated $5 to $10 billion.
Which is a massive coordinated action. I mean, the first of its kind since 2011.
Right, and it was executed to prevent these disorderly, chaotic movements in the currency markets from accidentally spucking global borrowing costs.
That was the goal, yeah.
But let's actually analyze the underlying mechanics of that intervention, because to me it seems wildly inefficient.
How so?
Well, the yen is collapsing primarily because of a massive interest rate gap between the two countries.
The yield gap, yes.
Right. Japan is currently sitting on a mere 1% interest rate. Meanwhile, the U.S. Federal Reserve under Chair Kevin Warsh is holding American rates steady at 3.5% to 3.75%.
That's a huge delta.
Exactly. So trying to prop up the yen with a $60 billion intervention while maintaining that massive rate gap, it feels like trying to hold a beach ball underwater while everyone else in the pool is standing on it.
That is actually the perfect mechanical analogy. Because capital operates on a very simple rule. It flows to wherever it is treated best.
Naturally.
And a nearly 3% yield advantage in the United States makes the American dollar vastly more attractive to global investors than the yen.
Right. So why even do the intervention?
Well, the joint intervention acts as a massive warning shot to currency speculators. It forces them to think twice before heavily shorting the yen.
Okay, I see.
But you are entirely correct. It treats the symptom, not the disease, until the macroeconomic fundamentals actually shift.
Meaning the Fed cuts U.S. rates or the Bank of Japan aggressively hikes theirs.
Exactly. Until that happens, spending billions on market intervention is just a temporary, incredibly expensive defensive maneuver.
Which really brings us to the most jarring contrast of this entire economic picture.
The alternate reality.
Yes. Every single topic we have analyzed today revolves around this agonizing, margin-squeezed physical economy. Manufacturing executives are panicked, global fuel is constrained by geography, normal people are taking on dangerous mortgage debt, and nations are fighting the gravity of interest rates.
It's all friction.
All of it. But when you turn your attention to the artificial intelligence and tech sector, you enter a completely detached, cash-flush, alternate reality.
The velocity of wealth generation in the digital infrastructure space right now is historically unprecedented.
Give us an example of the scale we're talking about.
Okay, consider Amazon's latest earnings report. The company just blew past a $3 trillion market cap.
$3 trillion.
And it's driven overwhelmingly by their AWS cloud division, which just posted $42.2 billion in revenue.
That is just massive scale.
But more importantly, CEO Andy Jassy announced the company is raising its capital expenditure estimate for the year to an astronomical $220 billion.
$220 billion in capex.
Yes, and that mountain of cash is being deployed purely to build out the server infrastructure required to feed global AI demand.
Which means all that unprecedented corporate growth translates into massive life-changing personal wealth for the software engineers and executives building these systems.
Obviously, yes.
However, because highly valued companies like OpenAI and Anthropic are choosing to stay private much longer than tech startups did a decade ago, these workers are sitting on massive fortunes in illiquid pre-IPO shares.
Which is a very unique kind of wealth to manage.
It is. And to manage it, they are exploiting this highly sophisticated financial vehicle known as a donor-advised fund, or a DAF.
The tax mechanics of a DAF are brilliantly engineered for high-net-worth individuals holding highly appreciated private stock.
Break down how they actually use it.
Okay, so step one. An AI engineer donates their pre-IPO shares directly into the DAF.
Right.
By making that transfer, they secure an immediate, massive tax deduction today, which aggressively offsets their current high income taxes.
They get the write-off immediately.
Yes. And then step two. Because the asset was technically donated to a charitable vehicle, the engineer pays absolutely zero capital gains tax on the massive appreciation of that stock when it eventually sells.
The structural irony of that vehicle is incredible. They get the immediate tax write-off. They dodge the capital gains tax entirely. But to me, the most appealing part is that they do not actually have to decide which charity gets the money right away.
No, there's no rush at all.
Those funds can literally sit in the DF, invested in growing tax-free for years, while the donor just leisurely plans their philanthropic strategy.
It creates a perfectly insulated ecosystem for digital wealth.
It really does.
I mean, think about it. The physical economy is constantly punished by geopolitical friction. A war in the Middle East immediately spikes the cost of diesel in California.
Instantly.
But the AI economy is constrained only by compute power and electricity access. It attracts capital at a speed we've rarely witnessed.
which allows digital workers to utilize these wealth preservation strategies that are just entirely fundamentally disconnected from the daily inflationary struggles of the median consumer.
Exactly.
Which really brings us to the core pattern defining the global economy as of August 2026.
Mm.
Every single mechanism we explore today is essentially an extreme adaptation to structural friction.
Yeah, we're adapting to a much harder world.
Right. Airlines are aggressively hiking passenger fares to cover geopolitical supply chain shocks. Commuters are purchasing 25-mile-per-hour golf carts because $50,000 sedans are mathematically out of reach.
And governments are jointly buying billions in currency to fight the unstoppable gravity of interest rates.
The entire global system is desperately scrambling to adapt to a world that has simply become much harder and vastly more expensive to physically navigate.
And the financial solutions being deployed across the board, whether it's that risky 7 times salary mortgage in the UK, a massive currency intervention in Tokyo, or shipping companies shifting vital maritime trade routes entirely around the tip of Africa, they're all acute stress responses.
They are.
And they successfully keep the global system functioning and moving forward in the short term, but they build up an incredible amount of hidden systemic fragility.
And that underlying fragility leaves you with a final lingering question to mull over as you watch these markets evolve in the coming months.
What's the takeaway here?
Well, if stubborn inflation and geopolitical supply shocks continue to make traditional physical assets like a standard four-door car, a single-family starter home, or even just cheap energy feel like exclusive luxury items, will the future economy simply become a subscription-based elite version of the American dream for the middle class?
Wow, that's a sobering thought.
While all the actual unencumbered wealth continues to concentrate entirely in the frictionless world of digital and AI infrastructure.
That exact divide, the intense friction of the physical struggle weighed against the frictionless velocity of the digital boom, that is the defining economic story of our time.
It really is the engine of everything right now.
It's the core tension that will dictate every major monetary policy decision moving forward.
Absolutely. Keep questioning the mechanics behind the headlines, and we will catch you next time for more financial analysis.